This is Section B Corporate Finance, which is 20% of the exam. Test questions will be at levels A, B, and C. Section B1. Risk and Return. The IMA learning outcomes have been restated as questions. Exam questions in this section will be mostly understanding concepts and definitions. Level A questions, so commit this material to memory. Identify and explain the different types of risk. Interest rate risk is the risk associated with changes in the market rate of interest versus the rate implicit in the asset. Interest rate sensitivity depends on the time to maturity and the coupon rate. Default risk is the risk associated with the company failing to pay some or all of the coupons and/or principal. Systematic risk is risk that influences a large number of assets and is also known as market risk. Systematic risk is largely unavoidable. Unsystematic risk is risk that influences a small number of assets and can be minimized or virtually eliminated through effective diversification. 1. Explain the relationship between risk and return. The relationship between risk and return is one of a positive correlation. Exposure to higher risk must be compensated for through higher returns. 2. Identify the different types of attitudes towards risk. How might these attitudes affect the management of risk? Investors' attitudes towards risk fall on a spectrum from risk-averse to risk-taker. Those who are risk-averse sacrifice the potential for higher returns for a lower, more certain return. Risk-takers will be more likely to invest in stocks that have higher risk and, therefore, higher potential returns. Risk-averse investors will be more concerned with having a well-diversified portfolio to virtually eliminate or greatly minimize unsystematic risk. 3. Define portfolio. A portfolio is a group of assets such as stocks and bonds held by an investor. 4. What is the difference between individual security risk and portfolio risk? Individual risk is risk associated with a particular security. Individual security risk can also be called unsystematic risk. Portfolio risk is the risk associated with the portfolio as a whole. Portfolio risk is similar to the systematic risk in that it cannot be completely avoided through diversification. 5. What is meant by the term diversification? Diversification is investment in more than one asset. The benefit of diversification is that returns do not move in the same direction at the same time, so some degree of risk is eliminated. 6. Explain the difference between systematic and unsystematic risk. Systematic risk is risk that associated with the market as a whole. It is also called market risk. It is viewed as unavoidable and affects individual securities and portfolios. Unsystematic risk is risk associated with individual or small groups of securities. It is avoidable through effective diversification. 7. How do individual securities affect portfolio risk? Individual securities affect portfolio risk proportionately based on their relative weight within the portfolio. Securities making up a greater portion of the portfolio have a greater influence on portfolio risk. 8. Define beta and its relationship to a security. Beta is defined as the amount of systematic risk present in a particular risky asset relative to an average risky asset. Beta acts as a type of multiplier in the sense that it multiplies the market risk premium by the amount of unsystematic risk associated with the security, which enables the investor to adjust the desired return based on the level of risk. 9. Explain the capital asset pricing model, CAPM. The CAPM is the equation of the security market line showing the relationship between expected return and beta. The CAPM states that the expected return of an individual security, (RE), is equal to the risk-free rate of return, RF, plus the market risk premium, RF, multiplied by the security's beta. RE equals RF plus RF x beta I. The CAPM shows that the expected return for a particular asset depends on the time value of money, the reward for bearing systematic risk, and the amount of systematic risk. 10. Define hedging. How can hedging be used to manage financial risk? Hedging refers to the process of reducing a firm's exposure to price or interest rate fluctuations. Hedging involves investing in securities that have opposite reactions to certain events. Through hedging, a firm can minimize the effect of certain events and allow the firm time to adjust its operations to adapt to the new environment. This concludes Section B1, Risk and Return.